All right. I want to do a quick video, and it's a question that just came. Um, I want it to be light. I'm tired. You ever have those days? I got my Texas Tech stuff. For all of you non-fans, I'm sorry. This is our year, at least football. We've got the national championship game coming up this weekend, which I'll be there. Anyway, rent house. Should I buy it or should I finance it? If you listen to, I don't want to pick on anyone, so I'm not going to say names, but some of these financial gurus who are preaching to people who really struggle to manage money, no debt, pay off your house, all of that stuff. Wrong, wrong, and wrong if you want to build wealth. So, there's two components really that amplify this. So let's assume $100,000 house, condominium, whatever. I use 100,000 because it's easy. I know they're not that cheap anymore, depending upon where you are. $100,000 house. You've got 100,000. Let's say you inherited it. You know, you can apply this any way you want. Let's just, for sake of argument, say you have $100,000. You can go out and buy one house, and I'm looking over because I ran the numbers I wanted to see, actually based on one of my rent properties, which wasn't 100,000. It was a little bit more, but I bought it years ago. But pay $100,000 for this place. You rent it for $1,250 a month. Let's say, and you have $400 a month in expenses. That gives you $850 a month net in your pocket. So you've got this $100,000 thing. Rent, the expenses are, let's say, $400 a month, insurance and repairs, whatever. You net the full $850. That's $10,200 per year when you pay cash for that rent property. That's cash on cash return, we call it. You put 100 in, it pays you $10,200 a year. Divide it, do the math, that's 10.2%. You think, man, that's great. No bank involved, nothing. But what if you put 20% down on that house? You borrowed $80,000 from the bank. With, let's say you got a 30-year loan. There's no one right answer here. Let's say you got a 30-year loan at 6%. I mean, some of my loans are 20 years at 6, 5. I think I got even one at 4.5 when interest rates were low. But let's just say, now that mortgage is $480 a month. So before you were keeping $850, now you're not. You're keeping $370 a month. Because before you owned the house outright, kept $850. Now you've got a mortgage to pay, but you only put 20 in, not 100. So you're keeping $850 minus $480. That's about $370 a month, which is $4,000 a year. Now hear me. Before you were keeping $10,000 a year, but it cost you $100,000 out of your pocket to get that $10,000 a year. That's a 10% rate of return. You use someone else's money, you get $4,400 a year on your original cost, $20,000. That's a 22.2% rate of return. Yes. The reason that is a little thing called financial leverage. When you use someone else's money, you can leverage up your returns that way because you put less money in. You're basically getting into the profit taking without being a partner with that bank, really. And you're having to pay the mortgage, but who cares? You're not paying it. The tenant is. You still cash flow. So when you look at how much do I put in, how much do I get out, that's the only thing you care about. I put $100,000 in, I got $10,000 a year. That's 10% rate of return. I put $20,000 in, I got only $4,000 a year. That's stupid. No, it's not. Because you've got $80,000 to still go do 4 more deals. You only put 20 in. Now you go do 4 more $100,000 houses. You get the picture. Don't start beating me up in the comments on the math. But you've got you're participating. Here's the other thing. Cash on cash is one thing. What else is happening in those scenarios? You've got tenants paying the mortgage, buying up your equity every year. Because when they pay, view it like that. The tenants are paying the mortgage. You keep what's left. And as they pay down your mortgage, you're getting more and more and more equity. You look up. And the other thing is you're participating in the market appreciation of that house, even if it's just inflationary, even if it's just 3%, and there's no real market movement, you're still participating. So for $100,000, you're now participating in $500,000 worth of real estate market appreciation. If you listen to Dave Ramsey or someone like that, and I don't know if he's still telling people that, and he's preaching to a different crowd. You know, there's some people that really need to hear what he has to say. But if you take $100,000 and go buy a house, yes, you've got instant equity, got $100,000, and you're participating. That house goes up by $3,000 a year. Okay, you participate in just that. You take $100,000 and break it into 5 piles of 20, and you go 5 deals like that. You're not only throwing your rate on cash to 22% versus 10, but you're participating in 5 houses, $100,000 houses going up $3,000 per year. Do the math. 5 times 3 is $15,000. In one scenario, you get $15,000 of appreciation in real estate. In the other, you get 3. In another scenario, you have strangers buying your equity. I can do this all day long. Leave me comments. I'll answer questions. There is no way faster to catapult yourself into real wealth building unless you've developed software or come up with a business idea. You know what I'm saying? I think that real estate is one of the fastest ways to participate. But you got to remember, if you get 100,000, I know some of you saying, I don't have 100,000. Okay, save 20. Buy an RV, put it in an RV park that'll let you sublet it. There are a million things you can do. Start a vending route. You've got to get to the passive income part of this deal. But I don't want to get off the horse, or the path, because this financial leverage is real. If you could borrow $5 million right now and you made good decisions, I'm going to give you a pitfall at the end. You've got to be careful. Don't go anywhere. Listen. But if you had 50 of these houses, man, now what are you participating in? Use no money of your own or very little, and you get into one house after another, and you start participating in the growth. That's what these guys don't tell you. If I could take a 21-year-old kid and give him $100,000 and he could go out and buy 5 rental properties and participate on each one of those rental properties going up in value, $3,000 minimum a year, let's say. That's $15,000 a year. If he listens to one of these financial gurus that tell him you don't want any debt, debt's bad, that's BS. Good debt is good. This is good debt. You get into one of these rental properties with debt, and man, I mean, you're participating in market growth at a very young age. You don't want to wait to save $100,000 just so you can pay cash for a rental property. I've seen it. I've watched it and done it personally. All right. The last thing, the pitfalls. When you use leverage like this, just as it can catapult you upwards, it could slam you downwards. I wouldn't suggest new investors without many assets go out and just start doing deals like this over and over. It's dangerous. You get one bad deal, you get, one house turned south on you. I had one like this. I tried to sell the place just because I was not happy with its performance. Couldn't sell it. Now I was asking 50 grand more than I paid for it 4 years ago, but I think it's still worth it. But the neighborhood was such that I could rent it all day long. I just couldn't sell it. So I'll sell it to another investor if I do. I just forgot about it. My point is, don't go get more than you can take care of. The worst thing you can do is to let a bank down. So if you go out, you had this 100,000 in my scenario, and you say, Chris, I don't want to do 5. That's too risky, because if something happened to the rental market and 1 or 2 of them I was waiting to re-rent, I couldn't pay the note each month. Let's say it took me 60 days to rent these. Don't go borrow money on a rental that you can't afford to pay the note. So in that example, 100,000, say you inherited it and you said, I want a rent house. Okay, do it. But only if the tenant moves out, you can still pay the note. If you want to go finance 1 or 2, you don't have that note if you pay cash for it, right? So if you tell me I'm living paycheck to paycheck, I inherited 100,000 and I want a rent house, first, I probably wouldn't advise that. It's just, you need to do this on scale. So, but maybe you're starting. I want to start with one rental. And I say, can you pay the note if the tenant bails out on you? Do you have a little side money? Can you keep some of that 100 grand as backup? Okay, yes. Do that. Borrow 80, pay 20 down. Put the other 80 in an interest-bearing account. Don't touch it. Don't blow it. Let that accumulate a little bit. Let you get comfortable. Then go find another deal maybe. But my whole point with that is, don't overextend yourself with debt and leverage. Just like I tell you, it's a great thing, it can also be a very bad thing. And that's probably why a lot of these guys say don't do it. Pay cash. Mathematically, that's not the way to go. But each case is different. So don't take my advice and go run out and start leveraging yourself all the way up. We're going to get into some more stuff with rentals. And my favorite secret, loans are not income. So if you were to happen to have a house with a bunch of equity in it and you refinanced it, you get money. The tenant pays your note. That money's not taxable. There's little secrets. They're coming. Thank you for watching.